This week, I thought it'd be quite an opportune moment to take a look at seasonals and what actually in particular happens for predominantly equity markets during the December period, and whether or not December and the Christmas period does actually see this Santa rally. So I've basically sort of taken a look at whether this Santa rally is naughty or nice for investors, and whether or not we can rely on it in terms of a trading strategy. Now, at this point, I should obviously say that past performance doesn't guarantee future activity. So whatever we find within this data doesn't necessarily mean that we're going to see it replicated this year or over coming years. But certainly it's interesting to take a look at how markets tend to behave in December and whether or not we start to see more serious movements and trends beginning to establish. So what I've done is to take a look at the USA 500 index going back to the year 2000 and plotted the performance of each December during each year. And we can see that there's no real consistent performance during December seasonals. Yes, we can see some reasonable up moves. December 2003 up 5.5%. December 2011 just under 7%, which was the best performer. And most recently, last year, we were up just under 3.7%. But equally, we can see that December hasn't always been a particularly strong month for equities. And 2002, down just under 7%. And December 2018, nearly 10% of a decline. So obviously, the underperformance of stocks within that period meant that we've pretty much on an average basis been flat throughout that period of time. So we've seen 15 Decembers since the year 2000 close up and 7 Decembers close lower from the 1st of December to just before Christmas. So that gives us a 22-year average of up 0.01. So not really anything that we can consistently hang a strong performance on or a reliable indication of price risk. However, when we talk about the Santa rally, it's really sort of thought that it's more the week before Christmas. This is when most of the professional traders are not necessarily active within the market, and it's retail, which are perceived to be more optimistic in nature, that is dominant within price activity. Liquidity is lower, volumes lower, and this can actually mean that retail and smaller clients can have greater influence on price activity. However, when we break down trading for the USA 500 index for the full week before each Christmas, while we do tend to close higher, predominantly more for those weeks since the year 2000, and we see, a reasonably consistent performance, we still see the odd week in December where we see negative performance and the risk of a more extended sell-off beginning to develop. So the full week before Christmas has seen 16 weeks where the market has closed higher, 6 weeks where it's closed lower, and that's produced an average rise over that 22-year period of up 0.5%. So again, not particularly strong in terms of relying on trading activity within the week before Christmas. Now, if we look at other markets over this period, and we take a look at the Germany 40 index, now the activity is slightly more positive in terms of the number of up months. Again, this is going back to the full December between 2000 and 2021. And there are more months where we do see an upside move within that period. But again, there are the odd months where, December 2002, we were down 11.4%. December 2018, down 6.1%. And again, that was 6 Decembers where the close was higher, 16 December, sorry, where the close was higher, and 6 Decembers where we closed lower. And that produced a slightly better average of up 0.92% over that period. So again, nothing too reliable in terms of significant price action that we can use within this Santa rally perception. When we look at the UK market, we can see again that we are actually seeing more positive themes materializing. December 2010 was up 6.7%. Last year was up 4.61%. But again, we see these periods, these months where December actually sees very sharp declines, and 2002 down nearly 5.5%, December 2018 down 3.61%. So while we do see more Decembers since the year 2000 closing higher within the UK 100 index, so we've got 18 Decembers closing higher, 4 Decembers closing lower, and the actual performance on an average basis of 1.71% is obviously, of what we've been looking at, the more stronger market and more consistent performance that we have been seeing over this period. Now, when we look at the year so far, this is looking at the early January open to November the 28th in terms of performance for each of these markets. And again, we can see that it has been a very poor performance, with the exception of the US dollar index, which was up nearly 11.5% over the course of that period, where we've seen a very strong and significant sell-off. But when we look at the extremes for the year, so basically here we've taken the 2022 high and compared it to the 2022 low, you can see that already we've seen significant movements within markets and within currencies as well. So the dollar index was up 21.28%, while sterling cable was down 24.5%. So again, very significant underperformance from the extremes of the year. Now, does this mean that we're now open to a Santa rally? Well, I'm afraid the historical data doesn't really support that argument. We're not really looking at consistent data to suggest that the Santa rally is a valid way of trading the markets. I think it's more a perception by the media that likes to talk about the Santa rally. It gives them something to write about when the markets are quieter, and not necessarily something that we can use for a trading strategy within markets. So does this mean that we shut up shop during December? Well, no, obviously not. But what it does mean is that we have to continue the strategies that we've been using throughout the year. We deal with what the market throws at us in terms of data and price activity and react to that, rather than trading the Santa rally perception of a strong market recovery into the Christmas period. So it does offer opportunities, but again, it's not something that the Santa rally can really sort of hang its Father Christmas hat on. It's more what's going on in the market, and price action is what we should continue to be reacting to. But again, because of the lack of liquidity and volume, it means that we need to be more proactive with our risk management, have tighter stops, reduce the exposure side to take into account that price activity and that volatility that may be seen during December and over the Christmas period. So thanks very much for listening. I'll be back again in the new year. Thank you.